Thank you. Representative Hanna.
Thank you, Chairman. Dr. Gravel, the conversation is simple around here and long in the tooth. We want to level the tax field, eliminate deductions, and lower the rate. But clearly, you don't think that the rate we may want to lower it to, whoever we are, is possible, in as much as you said that eliminating all the deductions is someplace between 3% and 5%. So, and I'd ask anybody this, does this mean our mission is impossible already?
Well, I think it's pretty tough. I mean, I think when you start with, I want this rate, instead of I want these tax changes and what that rate will lead to, that's when you can get yourself to something that you want that can't happen. Now, there's some things outside of tax expenditures that you could consider. One of them I mentioned in my testimony was restricting deductions for interest or disallowing the part that reflects inflation. There's other sort of non-tax expenditure-based broadeners like capitalizing advertising. There are things like that that you could think of, but even with those, it seems to be very hard. If you could do what the Wyden Gregg bill did, but they had they ended deferral. Without ending deferral, if that's off the table, then it's very hard to imagine, for me, to see a combination of provisions that will let you have a 25% rate, corporate rate, and a revenue neutral.
Thank you.
I think it's very difficult, but I do think that one of the reasons I was agreed to be an economic advisor to this alliance, and actually Doug Holzeken, my Republican counterpart, also agreed, is because we were convinced by work that is ongoing in the Congress that I believe Congressman Camp and Senator Baucus are leading and working with companies to really say, all right, we want a certain rate. Can we get to it? And if we can get to it, are we willing to give up all the things that we need to give up to get to it? And I've been struck by the fact that there is a very strong view in the business community that indeed there is a path to get to a reform which leads to a significant rate reduction that is revenue neutral, and revenue neutral in two senses. It's revenue neutral on the domestic rate reduction, eliminate credits and preferences. It's also by dealing with the transition tax on the repatriated earnings that are sitting outside right now, and going forward, you can actually get rid of deferral and make a territorial exemption system with base erosion protection, which does not lose revenue. Now, so I think we should work hard. This is the challenge. Those are ideal features of a corporate tax reform you would want. Let's see if we can get there. Many people in the United States who work on these issues regularly believe that we can. That's the challenge to the Congress to work to see if we can.
Thank you. Go ahead, Governor.
Congressman, just very quickly, we at Free Congress put together a program working with an economist we call the Growth Code. I would encourage your staff to look at it at freecongress.org. It's got a 5-element plan, comprehensive, revenue neutral. You buy down the rate on the corporate side to 15%. And you reform the personal exemptions. Double taxation is a key element. And then the repatriation issues and others. And finally, a refundable tax credit. It's revenue neutral, but the consequences on the dynamic side would be an explosive growth.
Is anyone here able to assume anything about compliance and the multiplier effect of being willing to say within capital gains, to Mr. Delaney's point, is that a 15% rate allows people to, or at least makes it easier for people to accept that rate and reinvest that same money, that amount of money in a much shorter period of time, where higher rates cause people to perhaps delay decisions.
There's a vast literature on that suggests that it varies quite a bit, but it suggests that the revenue maximizing tax rate is above the rates we have right now, so you could raise revenue At least that's the assumption that the Joint Committee on Taxation would make if they were scoring a capital gains tax increase.
May I interject just that I think that, sometimes the perfect is the enemy of the good, but in this tax reform debate, it seems like the mediocre is the enemy of the good. That we have to face up to the fact, Dr. Gavelle mentioned a literature that we're on opposite sides of, that the Joint Tax Committee, frankly, doesn't have a clue how to score a bill that's changing the international tax code, because the transfer pricing and everything is so complex. If we reduce the rate 3 percentage points, I tell you revenue's going to probably go up. But the point is that what's going on right now is the Joint Tax Committee is trying to give you a revenue-neutral bill based on scoring calls that are essentially impossible for a trained economist to make, and we're tying ourselves in knots to get it to add up to zero, rather than just trying to do the right thing and get the rate down. And so my suggestion is cut the rate a little bit for 3 years and see what happens. And if your revenue is too low, then do something about it. But to tie yourselves in knot over these scores that have absolutely no scientific merit seems to me extremely illogical.
And we do that
given our
pretty well, don't we? Thank you. Thank you. My time's expired. Thank you, Chairman.